Life as You Own It with Mark McDougall and Craig Miller.
Remember, you got questions, we've got answers. 800-492-4664. You may not take the time to educate yourself about the single largest investment and opportunity you have, that investment in the roof over your head in real estate. We talk about your home, financing, making investments in real estate. We give you the facts, folks. You know, it's just good old-fashioned horse sense that we like to talk about. And we also throw in some other horse stuff, too, just for fun.
Hey, Craig Miller, I'm Mark McDougall. How are you doing today?
Mark McDougall, I'm Craig Miller.
How you doing today?
I'm doing fine.
All right, this is Life as You Own It. Thanks for checking out the show, and we hope that you enjoy us so much. You tell your friends, your family, your neighbors, your Facebook pals, your tweetinators, all of those, and you get them over to Life as You Own It. So you can check it on your local affiliate, or you can podcast the show.
Tell a stranger.
Check us out at iHeartRadio. Okay, so, Craig, big show today.
Big show.
Big
That's why
show
we're trying
today.
to walk up to a perfect stranger somewhere in public in the next 24 hours and tell them to tune in to Life as You Own It.
That's right.
Tell them where to
So,
find it.
the weather is warm, some places, of where we have listening audience. It's cool in the Midwest, where the intergalactic headquarters of the Life as You Own It show are. But the real estate market, pretty much across the United States in most markets, it is pretty warm. And it is heating up quite nicely in some markets. So we're the show that you can catch not only the latest interest rate trends, but also how to negotiate your best deal on a house, what to look for. And today, we're going to talk about realtors that are walking the walk, or walking the talk, or talking the walk. One of those. I think they're walking the walk.
I might be talking the talk and walking the walk.
Yeah, you're going to find out what the heck we're talking about if you stay tuned throughout the hour. Also, if you're applying for a mortgage, what it should and shouldn't look like. Craig is going to drill down on that. Also, how much life insurance do you need? Craig, how much do you need?
I've got a lot of life insurance,
you know what?
But I don't want to
You're irreplaceable, buddy.
Yeah.
So I can't put a price
I'd have
tag
to have
on
life insurance equivalent to the U.S. national debt, which is close to what my value would be.
It is to me.
We're almost to infinity on the national debt anyway. So
Here you go. We've got the questions you need to ask yourself and your family to make sure you've got the right amount. And also, realtors that work both sides of the transaction. They're called dual agents. And what are they? What are they good for? And why does it matter? We're going to cover that later in the hour.
Is that like the spy realtors? The dual agent? They're working both sides and they're giving information just to fill their pockets, and then they're going to bolt and go live in
No, it's not.
Argentina or something.
But if you stay tuned later, you will learn. You too, Craig, will find out what a dual agent is.
Okay.
Have you ever played a dual agent?
No.
Okay.
But you probably...
You strike me as someone that might be a dual agent occasionally.
Well, when you were in the military, what was your job in there again?
I was actually in the Army. You, though, were in the Navy, right?
Yeah,
okay, we'll just drop the conversation there. So, and those of you that have served, we do appreciate your commitment to our country and our way of life, and thank you so much for each and every day that you put your life on the line and help us have this great life that we're afforded.
How about our first-time listeners? They don't know what they're listening to. They're about to find out, but let's share a little bit of what we do every week. Life as You Own It. You guys tuned into the right place if you're a first-time listener. This is the show where if you own it, we're probably going to talk about it. Now, we don't get into fashion. We're not going to get into what's in your pantry, probably, although probably sometimes
You obviously don't get into fashion.
But we are going to talk about things that matter most, your largest investments, your home. We're going to talk a little bit about life insurance today, your financial plan, your estate planning, taxes. It's going to be covered. We keep it around the home usually. We want to help you with those real estate investments, your primary residence, remodels, you name it. We're going to cover it. If we can help you maximize by being a well-informed, empowered consumer, that's our job here. But if you stay tuned every week, you're going to pick up a lot of additional information. And, of course, we cover rates every week. We give you the trends, where rates have been, where they're at now, where they're probably heading, things that you'll need to know so you can make those decisions going forward as it pertains to refinance, purchase loan, you name it, we're covering it.
Hey, shout out to our friends at KUDL 1660 AM in our backyard, Kansas City, and also KQAM 1480 AM Wichita. We thank you so much for being a part of the Life as You Own It network, and we're glad that you're tuned in to those fantastic stations. And folks, we're going to get this show underway, but we want to make sure that you know you can now, coming to a theater near you, actually we've got Christian Leroy is in the studio here, and he is getting some footage so that if you Google Life as You Own It on YouTube here probably in the coming weeks, you can find a little bit of footage. Some of it might even be unedited. You
might want to find out how ugly we really are.
That's right. You can see what goes on behind the scenage and during the breaks of the Life as You Own It show. And we are thankful to Christian, and we're thankful to you that go and check it out. So go to YouTube, type in there Life as You Own It, and you're going to find some of the footage to include probably tidbits from this show too. So, Craig, let's jump in. Interest rates, where they be headed?
Let's talk about it. Every week, folks, we bring you the national average. The national average is based upon a $200,000 average loan amount, 20% or more equity, somebody with excellent to perfect credit. So keep in mind, obviously, things can affect your quote that you would get or what you would qualify for as you know, with regard to what terms or rate. If you've got less than perfect credit, a smaller loan amount, a big jumbo loan, maybe not as much equity. But what we want to give you is this general national average guideline. Doesn't mean you can't find a better deal. The thing we want you to hone in on is where are rates kind of hovering? Am I in decent shape in that range? But what are the fees and costs? We got to watch those fees and costs, folks, because the rate is only one piece of the story. And as I mentioned, this $200,000 loan amount average, and also every week we share with you what the average points people are paying are, and it's right at 1 point. 1 point is 1% of your loan amount. If you pay 1 point on a $200,000 loan, that's $2,000. And that is in addition to, in many cases, the fees and closing costs that the lender may pass on to you for title fees, appraisals, their junk fees, whatever you want to call it. So pay attention to those fees and costs, folks. That's the part that can really get you. We always recommend that you go to our website and check out the break-even formula. Lifeasyouownit.com. The break-even formula is crucial in this mix because we want you to know how to figure how much money you're really going to save, how quickly will you break even from those fees and costs when you drop that interest rate. So let's get right into it here. 30-year fixed, 4.33 average over the past week. That was averaging about 4.39 the week before. We have seen rates improve slightly, obviously. The general technical trend, however, is that rates are on an upward swing. So we've had a little relief there. Rates are a little lower. Could be a great time for you to lock in a better interest rate. But you're going to have to do so fast because I still believe that rates may creep back up again next week. What's causing it? Stock market took some dipping. It took some hits over the past week, as you may have seen. And so it shaved quite a bit off. The Dow shaved 2.5, 3 points off. So that had a significant impact on where those investors parked their money. They were selling stocks and parking money in bonds, and that helped mortgage rates slightly. 15-year fixed rates, 3.38, first 3.45 average the week before, and last week 5/1 ARMs averaged 3.47 versus 3.55. So a pretty significant move in the adjustable rate mortgages. So the LIBOR index must have been lowered. FHA 4.21 versus 4.26 on a 30-year fixed FHA. Remember, folks, there's government fees involved in government loans like FHA, VA, etc. You've got to pay attention to all the costs and fees, compare loan types, loan terms, make a well-informed decision. Do the math. If you're not, and we're going to talk about this a little bit later in the show, what it should look like when you apply for a loan and what it shouldn't. But if you're just being dictated to and you're not really knowing what to ask and you're not doing the math for yourself, you may pay too much. Remember that always. And what do we have here, Mark?
All right, this is the should you stay or should you go segment. You give us your scenario, we give you an answer as to whether you should get the heck out of that mortgage, get the heck out of that relationship, get the heck out of that shirt you're wearing, Craig.
Like
no, please, you don't have, nope, you got an undershirt, you can get the heck out of that shirt. We tell you if you should stay or should you go. So set as your scenario, and we may take it on air. Frankie in Manhattan, Kansas emailed, I have a rate of 5.75% on a 15-year loan with about 11 and a half years left. I owe $56,000 and my house is worth at least $100,000. Should I refinance or leave it alone?
Go. Refinance that thing. Definitely.
Go. All right, Frankie. You got the word from the doctor. You need to go.
Watch the fees and costs, but you can definitely drop that rate down another
As we say every time, watch the fees and costs. Watch the fees and costs. Watch the fees and costs.
You got it.
Hey, Craig, walking the talk. Talking the walk. Walking the walk.
All of it.
Hey, interesting little factoids here from the Wall Street Journal. Realtors, guess what? 81.9% of them that earn less than $25,000 as their annual personal income are homeowners.
Wow.
Which is 25% more than the homeownership rate for all individuals in that income. So making less than $25,000.
This goes to show you they write off a lot of their income.
I don't know about that, but I'm going to say you probably can't afford to own a home if you make less than $25,000.
Realtors can.
You can imagine, and if they make more than $100,000, almost 91% of them are homeowners. But guess what? 89% of your homeowners if you make more than $100,000. What's this say? The wealthy are buying homes. The less wealthy, if they're not realtors, aren't. Life as You Own It. Stay tuned. All
All right, friends, we are back. Life as You Own It. If you missed the first segment, rewind. Hit the rewind button. No, you don't have a rewind button. I recommend you sign up for the podcast of the show, or you can just go into the archive shows. Can't they still do that, Mark? Can they listen on the site, on the website?
We hope so. Go to lifeasyouownit.com.
And
Check
find
it
out
out
for yourself.
That's right. And if you
Let
got
us know.
questions at Life As You Own It, or if you need some help on your scenario, you need some advice, you need a straight shooter, or several straight shooters, call 800-492-4664. One of the team members of the Life As You Own It network will be happy to give you some great advice. Heck, you may even want them to handle your transaction, and they will be pleased to do so. 800-492-4664. You can even ask for Dr. Miller, okay? We say doctor affectionately. He's not actually a PhD, unless you consider he's the doctor of love. And he's not. That was a joke.
What am I?
I don't know.
I'm the doctor
But
of
he is,
helping
we
you
can call him the
figure
doctor.
out
It's D-O-C-T-E-R.
There you go.
There, he's the doctor
I'll get that on my
of mortgage planning. So you can work with Craig Miller himself. Just ask for Craig. Give us a call. Okay, Craig, what's next?
What's up? I think people should be emailing their question, or questions, whichever you want to go.
Just like I asked them
singular.
to?
Yeah. I think they should be doing that more frequently. We're getting a lot of people emailing the show.
Agreed.
But I'm challenging any of you listening to call the 800 number, 800-492-4664, or email us, because we will give you this. I mean, you get the answer back. I've had people that send these emails, and they're so surprised when we send the email back, and they're like, wow, I really didn't know what kind of response I'd get. You need to go ahead and do it.
I'm going to start doing it.
So, there you go.
What's your response time on those, Craig?
Usually within an hour or two.
All right.
A couple hours.
Okay, so let's talk about the ideal mortgage scenario. What does it look like? Craig, tell our listeners, if they're applying for a mortgage, whether it's a refinance or a purchase, give us the details. What should it look like, and what does it look like? They might be two different things.
I'll tell you what it often looks like first. What it
Okay.
often looks like for most folks is that you make a phone call, you've been referred to someone, you heard an ad on the radio, you saw a newspaper print ad, TV commercial, whatever the case. You were prompted with some means or another to make contact with a mortgage lender. And when you call that lender, they begin to ask you a series of probing questions, which involve simple things like your name, address, date of birth, social security number, date of birth. That's it. Usually what happens, folks, is that you call someone about a loan, you tell them, hey, I want to refinance because I think I'm paying too high of a rate. Or, hey, I want to get pre-approved because I'm looking at buying a house. And they quickly move to the vital stats that they need to take down in order to pull a credit report. They'll ask you a little information about where you work and how much money you make, and before you know it, you're holding a pre-approval letter in your hand. Or before you know it, you're getting quoted a rate on a 30-year fixed-rate mortgage to refinance, or whatever type of term that it may be. And that's about it. You get a payment quote, sounds like it fits your budget, or yes, we can pay these credit cards that you're paying on too high of interest on, or whatever it is off. I mean, whatever the scenario, you're getting a very quick solution to your most immediate question, and you're not being asked any other questions or given any advice. That's what it looks like probably 9.7 out of 10 times when you call a mortgage company. Now, that's not at all what it should look like, and you should be very leery of any you're making a major financial decision, you're making a major financial investment if you're buying a home or if you're refinancing, you're committing to financial terms that can seriously affect your bottom line. It shouldn't look anything like that, folks. What it should look like is this. You call a professional who has concerns for your short-term plans, your long-term plans. If you work with a financial advisor, if you work with an accountant, what type of retirement you set up, how many kids you have, what your plans are to help them or not help them with their college, and what planning have you done so far to help with that. Many, many other factors. Your job, things about your job, how secure you feel in your job. Are you upwardly mobile? Do you expect any major changes financially in the next 2 to 5 years, whether you maybe income decrease, income increase? There's so many potential factors that need to be sat down and evaluated so that that professional can give you very sound financial advice. I recommend, before buying a home, before you make this major investment, if you work with an accountant, if you work with an investment advisor, that you sit down with that advisor and you have a good grasp of where you are financially and make a decision based upon advice of your wealth creation team. We've always called it a wealth creation team. That's people around you who are professionals and very good in their particular field at advising you. So that's going to be your accountant, that's going to be your advisor, financial advisor, and it's going to be your mortgage planner. And you may throw in the mix there an additional party that you, a trusted person in your family or friend or somebody that you have as an accountability partner or an expert in something that you invest in or otherwise. So what it should look like, folks, is that you're being asked a lot of questions that at first you may think are irrelevant, but are very much relevant to what your financial goals are, so that the mortgage that you're matched up with, even, I don't care how much you know, I don't care how in command of your finances that you believe that you are, someone should care enough to ask these questions, because they want to make sure they have covered all the bases for their own sake to give you really sound advice. Most people are order takers, and they're going to say, hey, yeah, you qualify for this, here's what your payment would be, here's what the rate is right now, blah, blah, blah. Shouldn't look like that, folks. So, words of the wise, I talk to people daily who are looking at buying a home for the first time, maybe not even for the first time. The realtor told them to go out and get pre-approved. They're calling me saying, well, I've talked to one company, I've already got a pre-approval, I just thought I'd look for a better interest rate. And before you know it, 20 minutes into the conversation, they're finding out that it wasn't about the interest rate at all. They had no advice given to them. In many cases, they were going down the wrong path, and nobody was going to stop them. So, find that certified mortgage planner, work with a certified mortgage planner, make sure that person is doing the practices that a certified mortgage planner would commit themselves to, and not just using the title as a means to make themselves seem like a greater, or higher level expert. And that's what you need to do before you take on this major financial transaction.
There you go. They should be armed with the education and the information that help you look at this like the largest investment you will make in your life. And folks, the reason we do the show is because we want to encourage you to look at your life as an opportunity, as an opportunity to play some tunes at any random moment, even in the middle of a thought, but an opportunity to have a plan where you can achieve goals, where you can get there financially fit, you can provide for your family, you can have peace of mind, all of those things. And it comes down to putting together a financial plan, putting together a plan in general, and you have the opportunity when you buy a house to do that. All right, I actually have the opportunity whether you buy a house or not.
That's right.
That music, it just threw me off. He brought the music in, it threw me out of my mojo.
It happens.
All right, what does that mean? That is, should you stay or should you go? We have a Shep in Oklahoma City, Oklahoma, called with the following question. I'm looking at buying my first home. I have 2 kids in elementary school, and I'm a single father. I have enough for the 3.5% down payment on an FHA loan, but that would only leave me with about 2 months' worth of my bills in reserve. Based on what I've been told a mortgage payment would be, I would save about $80 to $100 per month over renting. Should I buy now or wait? Okay, Shep, that's a lot of information for us to digest, but Craig's a quick digester. Craig, should he stay or should he go?
Stay, and that's going to mean wait in Shep's terms. You're going to definitely want to stay. He doesn't have enough reserves. He must listen to the show regularly, or somebody's told him about reserves. We always recommend you have 6 months to a year. I'm a big fan of a year. 6 months, is the bare minimum of your living expenses in reserve. He's, astute enough to realize that after he puts his down payment down, he's only going to have a couple months reserves. And although his payment is going to reduce, he may take on some additional expenses of home ownership he's not counting on.
We don't know how he came up with that $80 to $100.
We don't know.
So speak with a certified mortgage planner to identify as your real savings $80 to $100. Because if you just compare a mortgage payment to a rent payment, oh no, that's not apples to apples. That's apples to oranges.
Or bananas.
Bananas or tomatoes. All right, folks. That's your should you stay or should you go?
There you go. So
he must stay. Okay, let's move on down the road. We talked about life insurance, Craig. You're irreplaceable. So there's no amount that is enough for you. But what we want to make sure our listeners know is that there's some formula that you can apply and some questions that you should ask yourself to determine what the right amount is. So number one is, and here's just some considerations. One, what's your age? Premium rates usually increase with age, and here's a component of this you need to understand, folks. It's your future insurability. So even though we're talking about what's the proper amount, just getting you some is important at a young age.
Oh, yeah.
Because you got to make sure. Do you understand what your future insurability means? It means that when you're young and healthy, you can get life insurance.
What age do you think?
If you're older, regardless of your age, if you have some form of sickness, illness that maybe it's cancer, maybe it's something that's in remission, you're not insurable. All right, folks, when we come back, we're going to talk about the other considerations and determine how much life insurance you need. Life as you own it. Stay tuned. Oh, yeah. All right.
You always like bringing it back to this tune.
I do. Life as you own it, folks. Okay, speaking of life insurance, how much do you need? What are the considerations? Okay, number one is your age. Obviously, premium rates get more expensive, and got to make sure you get something when you're at a younger age because you got to get covered. I encourage you, even if you're single, and if you aspire one day to get married, get some life insurance, get some basic amount when you're at a young age, because you never know what life brings you, and you want to have something to protect and pay for your family in the event something catastrophic happens to you. The age of your spouse and children, which means how many years are you going to have to provide for support for them after you're gone. That can determine what amount you need. Folks, and understand that the amount of life insurance you need is not the same amount at all stages of your life. That's why we're given this information. What are your overall debts? So what is it going to take to pay off the debts so that your family is not worried about keeping up with the bill payer in the event something happens to you and your future income is no longer there? College expenses. What are you going to have to pay? And what we recommend is also taking that those tuition and fees. Make sure you factor in inflation. In fact, double inflation, and that's going to give you a good number to determine what you'll need for those college expenses. Your current income, if you've retired your debt and laid aside college funds, you may not need to replace your full income, but you've got to make sure, and some advisors recommend 50% replacement as a starting point. So what is your income? You should have at least 50%, but that's as a standalone. All these other factors that we've discussed also add on to that. Funeral expenses. Average funeral expense is $7,000, or it's anywhere from $2,000 to $4,000 if you're cremated. Craig, which would you prefer? You gonna be cremated, or you gonna have a?
I'll be buried.
You'll be buried.
Actually, I think a shrine's gonna be.
Maybe a temple?
No temple.
No, just a shrine. Small. What would the shrine look
I
like?
want to get bronzed. To be honest
So like
with
a, I think of like a, you know what I'd like to, like I think of a shriner. So we could have one of those little miniature cars,
you. Yeah.
and maybe you could just be wedged into that.
Or a monkey riding a dog.
So,
Something around.
anyway, I don't know where that one came
I don't know
from.
where it came
I don't
from
know.
either.
We're all confused now.
So, anyways, I plan to get bronzed and then buried. So.
Okay, so there are several ways to also determine the amount you need. One is going to be a multiple of income. The standard industry that you'll hear is 10 times your income, your annual income, 10 times. That we might call that a generic rule of thumb. So if you're earning $100,000, getting $1 million should cover. Now, again, factor in your debts, factor in those life expenses, factor all those things in also, and that's going to drive you to a more specific number. Another is called the shortfall calculation. And if you're not careful, you may actually have a shortfall. The shortfall approach works backwards from the annual income you would want to leave your spouse and your family for X number of years. After you decide on this target number, you then subtract all the other sources of annual income that will be available to them, such as your retirement accounts, pensions, savings, your spouse's salary, and Social Security. The resulting number is the shortfall you want to replace with life insurance. Does that make sense, Greg?
It does make sense.
Any elaboration for our listeners we think we need to give on that?
No.
Okay.
I don't want to elaborate, Mark.
Okay, you're not an elaborator. All right, and then the last is the income generator. And these are just 3 commonly utilized methods to determine the life insurance you need. The amount you need is some prefer to set their sights on building up a larger life insurance investment that would generate earnings to provide a beneficiary with annual income. For instance, $1 million invested using conservative average annual yield of 4% could provide $40,000 a year to a spouse or family into perpetuity. So you've got to understand, what is it that you want to accomplish for those, your heirs, your family members you're responsible for, and make sure that you use all this information to get to the right number for you. There is no one formula. There is no, it's 10 times. There is no, oh, you've got to use the income generator. Or there isn't one that's, oops, you've got to have shortfall, because the shortfall calculation, because you've got to go through what are the things important to you, what is it that you need to accomplish for your family to give you peace of mind when you're gone, that's going to take a little bit of time and effort. At a minimum, just get you some life insurance. If you're going to do nothing else, do the 10 times method if you can afford it. Okay?
Good point.
Anything else on there, Craig?
No, Mark. I think you've covered it.
All right. So
most people
on.
are well covered on life insurance, right? Statistically, not.
Right. Not.
Yeah, most people are way underinsured, and many people listening right now are driving down the road or listening at your home on your radio, and you're going, I'm one of those underinsured. Many of you are saying, I don't have any life insurance whatsoever. Remedy that problem immediately, folks. We want you to take action, get life insurance. I'm telling you, it's one of those staple things.
One thing I'm going to say is what you shouldn't do is, though, get mortgage credit life. I don't think that's it's not a product worth having, because it only takes into consideration one component, and usually the premium you pay for it versus standard term life does not make it a good deal. And I'm going to tell you real quickly, folks, when you get those numerous solicitations with no number, no name, etc., send this in for the life you need. life insurance you need and that your mortgage company wants you to have. It's not your mortgage company wants you to have it. It's the marketing company that is the insurance company that usually doesn't even have the company's name on there, that they're trying to trick you into filling something out with your social, and then ultimately you're suddenly going to start getting a bill for life insurance that you think your mortgage company wants you to have. Your mortgage company does not require, does not recommend any of those things specifically to have a certain amount of life insurance. So make sure you beware of those scams.
That's right. And
all right.
Any credit life, forget just mortgage, any credit life or disability insurance, whether you might be buying a car and you're financing that car, hey, we can give you this credit life and disability insurance for $30 more a month, and if this happens or that happens, forget about it, folks. Just go to your insurance company and get the proper insurance.
All right. Okay, Craig, so let's talk about what exactly is a dual agent, Craig? Do you know? And we're speaking to real estate.
Not spy novels.
We're speaking to real estate.
Okay.
Would you trust a dual agent? Dual agency occurs.
Depends on the individual.
There you go, and as you should, because you're a trusting fellow. Dual agency occurs when the same brokerage firm and sometimes the same real estate agent represent both the buyer and the seller in the same transaction. We're going to talk about when we come back what might be some of the pros and cons and some of the real data that tells you whether this is a good deal for you or might be a bad deal. Life as you own it. Stay tuned. All right, we're back. Life as you own it. Thanks for hanging out with us. And before the break, we were talking about pulling double duty. Real estate agents, dual agency role. It's whenever the real estate firm and or the realtor represent both sides of the transaction. That's the buyer side and the seller side. And the first thing I'm going to make sure that we want our listeners to understand is that you got to know, you're signing some paperwork. When you walk into a house that's listed, do you believe that you can negotiate best with someone that represents both sides of the party, or represents that party and yourself? Can it be done? Possibly. Are we saying that dual agency is a bad thing? Not at all, because there's some statistical data that we're going to let you interpret, and we're going to share our opinions on it. But researchers analyzed house sales in which a broker represented buyer and a seller. The study found, and this is from the Journal of Real Estate Research from 2013, dual agency sales in the first 30 days of a listing contract sell for a premium of about 18%, or 28.8 more for the average house. So sell for a higher amount. And if you are the seller, obviously there's no downside to you. You've agreed to pay the same amount. But the buyers could look at that and go, I'm paying more on average, 18% more if it sells in the first 30 days than I would be if it's represented if I have my own agent. That's one extraction you can take from that. Dual agency sales in the last 30 days of a listing contract sell at about a 6% discount, or $9,300 less. So somewhat of an equalizer. Overall, dual agency reduces home price by about 1.7%. So overall there, folks, looks like the buyer possibly comes out ahead in a dual agency role, and the seller may come out ahead because if the listing time is shorter, there's the data. That's why you look at data and go, if they're selling the house more quickly and for more money, is there a benefit to me? Okay, dual agency sales occur 55.1% more quickly than non-dual agency sales. Also, about 32% of all transactions are dual agency transactions. That's a lot more than I would have thought.
Mm-hmm.
So, folks, the bottom line is understand who is representing you, what the pros and the cons are. Make sure that you do your research and understand that if you're going to participate in a dual agency transaction and aren't specifically represented by a buyer's agent, that you do a little extra homework to make sure you're getting the right deal. As you can see, there are pros and cons. The best thing is don't have your blinders on. Don't assume that somebody, because they are representing both sides of the transaction, that you can't get a better deal. And on the same token, don't assume that there's efficiencies and a cheaper cost to you, because you are working with someone on both sides of the transaction. Make sense there, Craig?
Makes
so I walked right down the middle of the line on that, didn't I?
Yeah, you sure did. You're like, don't do anything either way.
No, do something both ways. Just don't do it uneducated.
Do your due diligence. And, of course, we just always want you to hire the most professional realtor you can find. Interview them, get a good feel for their experience level. That's what you got.
Your top pros are going to make sure you understand it. They're going to understand. You're going to make sure that you know that the deal that you're getting.
Some states it's not legal anyway, so sometimes you can't have.
What's that music? And why are you still talking? What's music playing?
I'm thinking about some other stuff here.
You got a lot on your mind.
Should you stay or should you go once again?
All right. Alexandra in Dallas, Texas emailed. Home prices keep rising in my area, and I have found a house I would like to sell in order to downsize now that my kids are out of the house. I think that's a good strategy, Alexandra. Do you think now is the time to move, or should I hold off for prices to peak? The other issue is that my mortgage is at 2 7/8 now, but a new 15-year loan would be almost a point higher. Do you think rates will drop? Oh, Alexandra thinks she's getting a 2-for-1.
Yeah.
So should you stay or should you go? And I don't know. Forecast on interest rates.
Well,
Craig.
I think she should go.
Okay.
Go, it means sell the house now.
Sell that house. Okay.
2.875%. She's got a great rate on her 15-year mortgage, and that's a consideration. But the fact that she's downsizing, the good thing about it is because home prices are now a little higher, she's going to capitalize on the recent bump in real estate prices, and she's going to, of course, pay that bump on a smaller priced home. So the gap should net her a good result there. Now, as far as the rate goes, you're not going to be able to compensate for that. The reality is rates are a little bit higher than that. You might be able to get a rate in the mid-3s with good credit. It is what it is, but if you wait, hoping that you're somehow going to time this perfectly, you won't know when the peak was until it passes. You won't know when rates hit their best until it passes. You can wait and try to figure that out. The fact is I'm a big bird in the hand person. Strike while the iron's hot. What's another little euphemism we could use? But the bottom line is you should go for it now because you know home prices are coming up and they are selling quickly. Get it done.
I was thinking of whenever you're leaving the ski lodge, usually you find the peak in the rearview mirror.
Yeah.
Right. So
Yeah.
It's kind of like, hey, like
Any
that.
other ones?
Deep.
Darren, you got any? Christian, come on, give us something.
Okay. All right. So Alexandra, we encourage you to consider your overall financial picture and look at getting out of the big house that you don't need and saving some money because the cost of owning that house extends beyond the interest rate you have. It's the maintenance, it's the upkeep, it's the utilities, all those things to do everything on a bigger space than you actually need to cover your needs.
Speaking of which, when we come back from the break, I'll comment on this because we're talking to more and more folks, baby boomer generation generally, who are retiring, looking at retiring soon. They're talking about downsizing, relocating. They're talking about moving into maintenance-provided communities. Lots of options, lots of considerations depending on your particular health, financial situation. I'm going to touch on that a little bit because there's good advice out there, there's bad advice out there, and many people have a hard time pulling that trigger when the time is right to move.
The great thing is the conversation we're having now is that home prices have appreciated enough, they're trending the right direction, that actually selling your house, getting a little money back out of it, and making this move is actually a possibility. We had a 3 to 5 year window where that was hard for a lot of people.
That's right.
When we come back, we're going to put a bow on the show and got some information you're going to stay tuned for. So life as you own it, stay tuned.
All right, folks, we are back. Life as you own it. Good stuff, Mark, on the last segment, but we want to continue on with what I was mentioning before we went to break, and that is retiring, perhaps. Are you thinking about downsizing? Are you thinking about moving into one of those maintenance-provided villas? There's a lot of considerations as you get a little older, and your ability to take care of a home is not quite the same as it used to be. The expense of taking care of a bigger home than you need, all those kind of things come into play.
You got it. Speaking of retirement, I got a little interesting article off bankrate.com
Let's
that is the 6 worst cities for CD rates. Now, folks, I'm going to give these cities, and if you live in one of them, I recommend you consider a bank not in your city. So, okay, we've got on here, we've got Pittsburgh. The average 1 year CD rate is, guess what, Craig? Guess what?
0.04.
0.13. That's assuming a minimum $10,000 investment. 0.13, $10,000 CD. And in Chicago, 0.16. Those bankers are getting rich in Chicago. Cleveland, 0.17. We've got Milwaukee, 0.17. There's the common theme here, isn't there? These cities are fairly close to you. And then, we jump out to Seattle is 0.17 also. So, folks, understand. And then last is Detroit. 0.18. Is that 5 or 6?
Yeah, I thought Detroit would be even lower.
That's it, folks. So
That's
those
6.
are your 6 where you need to make sure that you get with a bank that maybe has a footprint in other locations because though we'll agree, and we know that the yield on a national average yield might be 0.26 or 0.27, and it doesn't say, you're like, gosh, that's not a whole lot more than I'm getting. Well, it's 30 to 40% more than these cities are averaging. It's double what you would be getting in, would we say, was our first one? Cleveland.
I think it was. Or
Yeah.
Hoboken.
Pittsburgh.
I'm
Yeah,
kidding.
something like that. Poughkeepsie, Pittsburgh, 0.13.
That's what it was.
All right, you Pittsburgh bankers, gosh, you're just rolling in the dough.
That's right.
How do you sleep at night?
All right, so folks, if you are before that very meaty and interesting tidbit Mark shared with us.
Oh, excuse me. I think it was very meaty and very interesting.
It was both, Mark, just like you. All right, so
Thank you.
going back
Thank you very
to these fine folks that are saying, hey, it's time I look into perhaps what I'm going to do for my final home, or at least a retirement home.
Yeah.
And some people have a very clear-cut plan. They're in a great financial position, and they want to move to, sunny Florida, buy their retirement home, and play golf and relax in the good weather. Well, do some snorkeling. The reality is that not everybody's in that position, and what I find, just as happens when people are purchasing a home, oftentimes it's an emotional decision. The same is true for people who, when the time comes to sell, they struggle with it from an emotional perspective. I talk to a lot of folks that are retired already, who say, we just love our home, we're close to friends and family, we've been here for 25 years, and we just can't imagine packing everything up and moving and da-da-da-da-da. Well, the kids still love to come home for Thanksgiving. All those things on the table, and I appreciate and respect all those bullet points that they share with me, but then we look at the financial picture and we say, but you need to sell your house. So, folks, my encouragement as we wrap up the show today, for those of you in this position who are contemplating what your retirement's going to be like, or you're already retired and you're looking at maybe doing a reverse mortgage, which we're going to speak about reverse mortgages next week on the show. Make sure you tune in for that. Just take the emotion out of it as best you possibly can and make it into a business transaction. You're going to be okay. You'll have a roof over your head. But if you wait too long and you drag it out, it's going to cost you money and make your retirement that much more crunched potentially. So make your move when it's time to make your move, and base that off of financial figures and facts, not your feelings.
There you go. All right, folks. Next weekend on Life as You Own It, we're going to touch on sometimes a confused beast. That is the animal that is reverse mortgages. And I say it's not a confused beast, but many people are. The perception, they look at it like a lion, one that if they're not careful, it may bite their arm off. Am I right, Craig? Is that a little over-dramatizing?
I don't know if it'll bite their arm off. But
It won't bite their arm off, but sometimes people have this perception that reverse mortgages are a bad thing. I'll tell you,
sometimes they are.
They can
I'll
be.
say it right now.
You tune in next week, you will be an educated consumer, and you may choose to follow the path of the reverse mortgage. Life as You Own It. Remember to
Stay classy.